Where are we along the Bitcoin adoption curve, and what does that mean for the price growth? Can Bitcoin reach millions of dollars a coin in today's dollar terms, or is this it? Are we at full value already? We're here to talk about this topic with Dan Held. He is the Director of Growth at Kraken, one of the world's largest crypto exchanges. Dan is also the author of the weekly Held Report, a widely followed blog that covers all areas of cryptocurrencies. On his own podcast, Dan has interviewed many notable figures in the cryptocurrency space, including Michael Saylor. Dan has followed the markets for many, many years and is well respected on social media for his commentary on cryptocurrencies. He's also worked in the tech sector prior to working for Kraken at companies like Uber. So he understands both the tech side and the monetary side of cryptocurrencies. In part one of our conversation with Dan, we'll be talking about market manipulation potentials for Bitcoin, as well as potential problems with Tether. We'll see with recent news. And in part two, we'll talk about the price adoption of Bitcoin and regulatory problems that could potentially bring headwinds to the price. Dan, it's an honor to have you on the show today. Welcome to Kitco.
Thanks for having me.
Let's talk about recent news. Tether, the producer of Stablecoins, the executives were just recently probed by the Department of Justice for bank fraud. I don't know if you've been following this case. It recently came out, the story not too long ago, yesterday. And so it's a fresh story. Does this have any broader implications for the crypto market? What's going on?
Well, there's a few things to cover here. First and foremost, I believe that the quote in the newest concern with the Department of Justice, that quote comes from someone familiar with the matter who chose to remain anonymous. So I don't believe that came from the Department of Justice. It came from someone that a journalist considers to be a good source, but that is an unverified sort of news story out there. But this isn't the first news story that's come out about Tether. In fact, over the last 5 to 6 years, people have been concerned about Tether, that it's not backed, that it represents an inherent, huge risk to the system. And I wrote about this in the Held Report, where I think concerns on Tether are a bit overblown for a couple of reasons. One, yes, there have been concerns around auditability, but they recently settled with, I forget the regulatory agency, but the regulatory agency based out of New York, they recently settled and perform quarterly audits now. So the bank statements are audited, so we know exactly how much is held in reserve that would back Tether. Second, there have been 10,000 cryptocurrencies that have come and gone during Bitcoin's existence. Some of those went to zero, and that did not represent a material risk to Bitcoin. So Tether is one of many different crypto assets out there. And even if it went to zero, or if it's found that Tethers were unbacked, or there was some other huge glaring issue, that doesn't necessarily represent a long-term risk to Bitcoin. Yes, there would be a short-term price movement, but that wouldn't influence Bitcoin materially over time. There are tons of other rails to buy Bitcoin with. So, with some of the Tether FUD, one is Tether backed or not? Well, now they perform quarterly audits that are public and transparent, so we do know they are backed. Question number two is the question is if Tether is used to print Bitcoin or used to manipulate Bitcoin. Well, the research report that kicked that conversation off years ago was done by 2 University of Texas professors, where they concluded that correlation is causation, which violates a core fundamental tenet of basic data science. It's a very big embarrassment for the University of Texas to have individuals publishing information like this. It's sort of like saying umbrellas cause rain. So they performed that, did not find any causational relationship, but they said that correlation equaled causation. So they're like, oh, more tethers are created as Bitcoin moves up, therefore tethers make Bitcoin move up, and that's materially not true. We don't find that to be the case. There's a couple different other ways to think about it. One is that more USD or euros or pounds are deposited at exchanges as the price of Bitcoin goes up too. That's not necessarily saying that it's artificially manipulated. It just means that more people are moving money in to be able to go buy Bitcoin with it, or crypto or any other asset. And then number two, there's a cryptocurrency called USDC. USDC is another stable coin created by a company called Circle. where's all the concern about USDC being printed and that manipulating the price of Bitcoin? Of course, you don't see any of the Tether, although the concern trolls on the Tether side highlight any of those metrics, because if you did, it would be the exact same metric it shows. As the price of Bitcoin goes up, more USDC is being created. So there's a lot of ways to pull apart this argument that Tether represents this huge material risk to the system, that it manipulates the price of Bitcoin. Bitcoin's price is being discovered across dozens of venues across the world using a wide variety of different types of assets, whether that be USDC, USD, euros, yens, pounds, etc.
Fundamentally, are stable coins prone to being manipulated as you speak, or prone to being used for manipulation?
That's a great question. I think the real, what we should be concerned about is that Tether, USDC, these type of cryptocurrencies, these stable coins, these aren't necessarily decentralized at all. They're completely centralized. So what happens is a dollar goes into a bank account, and then on the other side of that, on a blockchain, there's this certificate or representation of that dollar being deposited. And so that's why it's called a stable coin, is there's a backing of a dollar or a euro in that bank account that represents this digital version on this blockchain. Well, blockchains and Bitcoin, in particular, were built to be decentralized, which means that there's no central point of control. So what you're doing is you're bringing this asset that is completely controlled, because USDC, those can be censored, those can be blocked, and those can be reversed. These are not like traditional cryptocurrencies that are irreversible and are not censorable. So with that, I think that's a bigger risk to this I think that's a bigger risk to the crypto ecosystem if these coins are someday, there are examples of where Tether and Circle have censored transactions based on local regulators. So if there are DeFi platforms that use USDT or USDC as collateral, that could have a circumstance where if that collateral is frozen or reversed, that could unwind in a very bad way in the DeFi ecosystem. So I think in the DeFi ecosystem, stablecoins represent a very inherent problem with the collateral in the space, because the collateral is centralized and not a native token like Bitcoin or like Ethereum.
Okay, so let's talk about manipulation now. Let's go back to Bitcoin in particular. You've written about Bitcoin manipulation on the Held report, and I'd like to touch on this. So what do you mean, first and foremost, when you talk about Bitcoin manipulation? Because anybody who understands fundamentally, or even just on a base layer, a proof of work, would argue that it's very difficult to manipulate something like Bitcoin. So I'm curious, in the traditional financial sense at least. So I'm curious as to know what you mean by that.
Yeah, the Bitcoin protocol is very prone to, the Bitcoin protocol inherently was made to be decentralized and very resistant to any sort of centralized attack or manipulation. So the protocol itself is extremely stable. I mean, the Bitcoin protocol can survive it could survive in nuclear warfare. The Bitcoin protocol could survive part of the internet going down. The Bitcoin protocol was built to be intensely resilient. Now, the price of Bitcoin can fluctuate because the price is being discovered across multiple exchanges, and it's an open market. And so a lot of people, especially when Bitcoin goes up tremendously in value or drops significantly, equate that to being manipulated. They go, oh, wow, there's no way an asset moves like this unless there are big mysterious players, choosing to move the market. Well, Bitcoin has no inherent price stabilization mechanism because it's not centrally controlled. There is no one party that controls the supply to reduce the supply or increase the supply to stabilize the price. So that's why we see such a wild fluctuation. A lot of people scream, oh, Bitcoin's price is manipulated. There must be big forces at play to move it up or down. So this concern has always existed in Bitcoin, especially due to that price volatility. And I wrote this to represent kind of a more macro thinking around what is price manipulation. Whenever you buy a stock, you as an individual trader, let's say for $5,000, you move the price. Every single market participant moves the price. And so I argued, if we look deeply at what the word manipulation means, or if we look at defining manipulation is actually much more difficult than we thought. Market participants buy and sell different assets and move the price. Was that intentional to move the price or not? Did they have a malicious intent? We'll never know that. And there's tons of market participants all across the world doing this for every single asset. Gold, stocks, bonds, Bitcoin, it's all the same thing in terms of trading. There's a buyer and a seller, and they all come together and have different, different levels of intent and different levels of how much they want to buy or sell. And then all of these prices, so the price of Bitcoin is tied together to the price of Litecoin and Ethereum and gold, and all of these interplay upon each other to where some people want this simple narrative of like, oh, the price went up today due to these whales or due to market manipulation. But in reality, it's this super complex, nuanced conversation of everyone moves the price. Was that intentional? And there are so many different waves in the ocean that came together to define what the price is today. It's nearly impossible to say, oh, one actor could push it this way or one way. So it was a more meta take on the idea of thinking through prices and manipulation and evil versus good actors in the system.
Okay, so let's comment on market manipulation. I think, in my opinion, the main two factors that determine whether or not an asset could be easily manipulated by market movers, so to speak, are liquidity and what percentage of the asset is owned by a minority of stakeholders. Can you comment on both of these factors for Bitcoin?
Sure. Yeah, so Bitcoin is more liquid than Apple. Apple is one of the most highly traded stocks in the US, or in the world, right? So liquidity is a function of, I would say, like three different things. One, market capitalization. Two, volume. So the number of the value of the assets exchanged that day. And that's where the Apple reference comes into play, is like total volume. So how many shares traded hands or how many Bitcoin traded hands in one day. And then depth of the order book. So depth of the order book demonstrates how much slippage would occur if an order was placed in either direction. So a sell order or buy order. And when we look at Bitcoin, Bitcoin has become more and more liquid and more, having deep institutional level liquidity over time as the market participants have become more and more. So this represents as Bitcoin becomes larger, it becomes harder to push the price around if you had ill intent. So that answers the first part of the question. Second part, actually, can you refresh my memory on the second part?
The percentage of coins owned by whales or a minority of stakeholders.
Cool. Yeah, so the distribution of Bitcoin is kind of a constant question. A lot of people do a bad analysis of this where they look at on-chain balances and they go, oh, well, the Gini coefficient of Bitcoin is corresponding to these different addresses that I see, and they hold certain amounts of Bitcoin. Well, one of those addresses can represent 50 million customers like Binance or millions of customers like Kraken.
Right.
So it's really hard to parse through the on-chain data and go, oh, this is the distribution of Bitcoin. Now, certainly based on Bitcoin's initial distribution, some earlier members have a nice chunk of them. For example, like Satoshi might have close to 1 million Bitcoin. These I don't think are as big of a concern because over time, we've seen most of those early coins either have moved by now, very rarely move, or they've more than likely have been lost. So that early distribution of those, like a large percentage of the coins, most of those coins have either been lost and or already moved around or spent. So the worry that there might be a giant chunk of these coins unlocked from that early era where someone finds this wallet with 200,000 Bitcoin and decides to go sell it, I think we've already seen a lot of that already occur. Bitcoin has been traded for 10 years, and most people don't have the fortitude to hold on to something worth that much money for that long without wanting to sell part of it.
What happens when all 21 million Bitcoins are mined then? What happens to the liquidity profile then?
Yeah, great question. So Bitcoin has an issuance schedule that was started since day one and will continue until the year 2140 approximately. And so Bitcoins are produced along the supply curve. And at one point in 2140, the number of new Bitcoins the newly created Bitcoins will essentially go to zero. And that means that 21 or very close to 21 million will be produced. From a liquidity perspective, there's a really interesting dynamic between Bitcoin's supply curve, so the issuance of new coins, and these moments called halvings. So halvings occur every 4 years. And what that does is that is the decreasing or the decay rate of the issuance schedule and until it reaches zero. And And Bitcoin's price cycles are somewhat intertwined with this, as these halvings occur, which reduces the number of newly minted Bitcoin being created, so that reduces selling pressure. Then, if demand stays the same or goes up, the price starts to creep up. More people become aware of Bitcoin. As people become more aware of Bitcoin, they buy in an expectation that it might go higher. After they do that, they start to learn more about it, and they become increasingly, part or involved in the community and become a Bitcoiner, someone who really likes Bitcoin and believes in Bitcoin and wants to store more and more of their wealth in Bitcoin. And these are the speculative cycles that have increased Bitcoin's adoption, have increased the usage of Bitcoin, and are why we're talking about it today. If Bitcoin had stayed at $1, we wouldn't be talking about it. Bitcoin's volatility is its calling card, and it taps into innate human nature of the speculative nature that we have, the want to pursue something with a return. It's this really beautifully simple solution for the bootstrapping problem. And Satoshi actually hypothesized that this might work back before Bitcoin was even worth a penny. Satoshi basically hypothesized that FOMO, due to the extreme scarcity of Bitcoin, because Bitcoin, no more than 21 million can ever be produced. So during these speculative cycles, the price goes up, but no more Bitcoin are produced. So the price goes up, and if demand keeps going up, that causes these really intense volatile price periods. And those are the periods in which Bitcoin grows in adoption, volume, liquidity, and companies building products and services for Bitcoin.
Okay, well, let's hope our society lasts long enough till 2040 to see the day that all Bitcoins are mined. That's a different topic for a different time.